Disappointing. How disappointing?
Yeah, you're right. That is a word that's been used to describe it all day. It's disappointing. What everybody was looking for was a net debt number to come down, and it did from 40 billion towards 39. But I think people have been hoping to see it below that $38 billion level, and more importantly, expecting that to come down throughout the year. And the guidance that net debt would actually go up in the first half of the year, reflecting severance payments, the Gulf of Mexico spill payments, came as a little bit of a disappointment, particularly given where oil prices are. But they are guiding to on that net debt number using a $45 to $50 oil price, which is clearly below where we are. But I think it is a recognition that BP is work in progress.
So, Lydia, a year ago was when BP sort of unveiled this new strategy that they have. And I wonder, how long does Bernard Looney have to show the street that he can make money off of this new strategy?
Yeah, I think the strategy that they've taken is absolutely right. And it's important that the company evolves as society evolves and what those demands for low carbon actually end up with being. I think a lot's been made of the planned 40% reduction in fossil fuel production by 2030. And from an investor side, does that translate to 40% lower cash flow? I'm pretty clear that the answer to that is no. And what we should see is margins improve as we go through. But it's really important, I think, that 2021, we actually see evidence of the delivery of those numbers. That actually seeing profits improve, seeing costs come down, all of that will come through, I think, as we go through the year. And it's important that we actually start to see recognition of the value that they can create in that low carbon business, because that's still a question mark that a lot of investors have.
This has always been a stock that people have had for income. As you say, we need to get to that 35 billion. We still have question marks about what is happening in the sustainability side of the ledger. How should we think about BP? What kind of investor do you think should be looking at this kind of stock? Do you think we get back to the point where this is the kind of an income investor darling?
It was interesting that today they did talk about the ability to go from 5.25 cents per share on the dividend up towards 10 cents per share in a $55 world, and that includes the share buyback. So they're certainly confident about the ability to generate that cash flow and start to return it to shareholders. For me, I do think that as society evolves and as the markets evolve, that we will see low carbon businesses rewarded, and that the work that they're doing around the sustainability side will start to pay off. And the reality is it takes time. It is going to take time to transition from a big oil stock towards the integrated energy company that they want to be. When I'm looking at the numbers, that transition point ends up being about 2035. So we're still quite some way off there. It does take a while, but the cash flow is resilient to 25 and cash flow should be growing. So I do think that we'll probably get to that 35 billion debt number a little bit earlier than they're indicating at the moment. And actually, if at a 6% yield, we should be starting to see dividends, also the buybacks start to come through. So I do think it's an income stock.
Lydia, what I think a lot of investors wind up struggling in this particular space is that why own BP when you can own Total? That's already in the middle of the transition, can do it a bit more quickly. They don't have the Gulf of Mexico still hanging over them in terms of the payouts. They have a higher dividend yield. They're rotating into alternative energy much more quickly. And it begs the question, like, why BP?
Yeah, I think all the energy stocks, and particularly in Europe, have a role to play, and they are leading the way on that low carbon positioning. Total is still my favourite of the European companies. It is our top pick, and as you're right, that it does have a higher dividend yield. But I think there is a role for both, and particularly for BP, the ability to restructure. They do need to take out costs from them. There is a lot of room for efficiency to come through, and I think it's a bigger change for BP than it is for Total. And so that pace of restructuring from BP is greater than we're seeing for any of the companies, and I think that's exciting.
Why are energy companies lagging the oil price pickup?
I think some of this is the guidance is still very cautious. So there is that nervousness, particularly from the management teams, that we're only 1 month into 2021. That the guidance you're seeing is still being set on that $45 to $50 level. And so they're not getting too carried away with where the oil price is. And I think the market had hoped that we'd see a little bit more excitement and that maybe we'd see that positioning about buybacks being brought forward a little bit earlier. Maybe we might see more cash returns earlier. And we're just not getting that. It's being moderate, cautious approach. And I do think there are still question marks about what role the companies have in energy transition and whether they can make money out of it. When I look at it, they have all the skills that they need, the global engineering skills to be able to do it. And they are the ones that can make a difference at scale. But we need to see examples of that.
Yeah, and sort of all the different parts of their business, gives short-term risk, but then maybe long-term gain, right? They're integrated, so they have all the pipelines and networks, the trading, which brings me to refinery. Not to just drill down, but BP got hit on refining margins and demand. Exxon got hit with the same thing. Chevron got hit with the same thing. That would help short-term to stabilize. When do you see the bottom for refining margins?
We're still a long way in terms of demand recovering to where we were. We're looking at returning to pre-COVID demand levels probably 2022 rather than 2021. And that does leave us with overcapacity in the refining space. So as demand picks up, we'll start to see some of those margins recover. But it's still going to be, I think, a long road for us on the refining, certainly for this year.